Kia ora koutou, welcome to the Shared Lunch, brought to you by Sharesies. I'm Garth Bray. Look, we've recently had some staggering results from the world's biggest company, Nvidia, to which investors said, what is going on in tech? We are getting right down into the weeds with tech sector specialist Andrew Curtayne from Milford Asset Management. Before we do that though, some important information you should always consider when investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Okay, Andrew Curtayne from Milford Asset Management, a tech sector specialist, does what all day?
Well, in my job, it's tech sector specialist looking at equities. So we look at the stock market. I focus on the tech sector. So the tech sector would include anything from software companies like Microsoft or Salesforce, semiconductor companies like Nvidia or Broadcom, right through to, say, communication services, which includes companies like Meta or Google, Amazon, included. So my job in the tech is to sort of focus on researching these companies, get to understand them, understand their industries, and then feed that into stock picks, which go into our funds at Milford Asset Management.
I guess we've got two results that really frame things quite remarkably very recently. We've got Nvidia reporting, I think it was its quarterlies, and Salesforce reporting quarterlies. And if you want to pick an analogy, whether it's railroads or whether it's gold mining or whatever, you've got a company there that is building the infrastructure, building the way that this will happen in Nvidia. And you've got a company in Salesforce that's building the thing that's going to clip the ticket, right? So let's start maybe with those. What's been going on with these companies lately?
Both of them are in sectors which have very big end markets in their own rights, but the way they participate in this technology stack is very, very different. So as you sort of gave that example of a railway, Nvidia is sort of like the railway company. It is the company that is laying the physical infrastructure to allow artificial intelligence to grow and become a part of our daily lives. So it's building the physical chips that power AI data centers. So that's the brains. That's what make these data centers tick. And
that's the point of scarcity, which we'll come back to later, because anywhere you can find scarcity and there's a company capturing that, they're going to be capturing a lot of value, aren't they?
It turns out there's a lot of scarcity in AI at the moment because it's growing so fast. So it makes the supply of everything going into it a little bit challenged. So that's what Nvidia does. It designs these chips, and they're very important chips, and that's why they are the largest company in the world. Salesforce comes from as a software company, and if you look back over the last 15 years, one of the best sectors to be invested in has been software.
And they specifically do like customer relationship management?
Yeah, it's called CRM, customer relationship management software. And so they basically provide software which sits on your computer, and it helps make people that work in sales, people in marketing, people in customer services, makes their lives easier. It will track the relationship, it will help you find leads for customers you want to call, you call them, it will help record all that information. It might then pass that information on to customer servicing people who then have to deal with their complaints when they come in. And so it'd be sitting in sort of the top sort of 5 to 10 software companies in the world by market cap. So it's been a very good business. And it's also a business which is called, which is a cloud-based business, which what that basically means now is you don't actually have to physically buy any hardware to run their program. It's all stored on the cloud, and you get a subscription service, and you sort of pay like this sort of yearly subscription to get access to their software, and they'll upgrade it for you and it'll get better. And at the moment there's big debate about which is the better business to invest in. Is it the software companies, is it the hardware or the chip companies?
If we look most recently, I think so Nvidia, it really surprised people with its most recent quarterly update. I think what we're looking at revenue of like 68 billion US, and it's sort of targeting a whole lot more than that, 78 billion in the next quarter. These are staggering numbers. How come the stock price is just kind of like dropping or rising or doing whatever it's doing? What's going on there?
Yeah, well, the share price actually fell 5% after, which is one of the biggest beats the company's had in sort of recent result quarters. And I think you sort of need to step back here and realize listed stock market investing, particularly in the technology space and particularly in these sort of environments with uncertainty, the short-term share price action doesn't always sort of reflect exactly what the fundamentals are from the piece of news. It often does, but at times it can stray away from that. So I think every single person looking at the Nvidia the Nvidia result yesterday, I would agree that it was a really strong result. As you sort of said, it guided to a 10 billion quarter-on-quarter growth in revenues from 68 to 78 billion. The market thought the revenues should have been guided to about 74, so a $4 billion beat is 5 or 6%. That's a huge beat. So what that is telling you is that demand for their products are really, really strong. They're able to sell their products at good, strong prices. They even confirmed that the profit margins they're making on these products were as good as everyone was sort of hoping to see the numbers come out. So there was no real negative in the result whatsoever. So why did the share price fall off 5%? Well, the positioning, what we call positioning, is the amount of investors that own certain companies or certain stocks is really long semiconductors at the moment. Semiconductors has been an area which has sort of been, you'll probably say the headline of the AI rally so far on the stock market over the last couple of years. So a lot of positions own, a lot of investors own Nvidia. They're really long in it, and it gets harder and harder for the incremental positive news to keep pushing the share price up. So sometimes you get people sitting there, and the investors, and particularly hedge funds and really short-term traders, are sitting there going, right, on the Nvidia result, we're going to sell our winners, which is the semiconductor companies, and we're going to go back and buy some of these losers, like the software companies, which have been selling off. And it's almost like it doesn't matter what the result is, it's going to happen that way. And so, we see it as a bit of a short-term, maybe pullback in Nvidia's, but we're not sort of like translating this into this is actually a negative result.
You're seeing, and you're talking to your clients and saying, we see this a future for this company in line with its results, kind of thing?
Yeah, I mean, we're an active manager, so we move our positions and move our views quite regularly, and we move that based on the information that's in the market. It could be on the results of the company, it can be leading information. And in the case of Nvidia right now, what really drives the value of Nvidia is for how many years are they able to grow their revenues from the sale of these chips. Now, what makes you grow your revenue from sale of chips? Well, you need the demand for the chips. So you need more people using AI, you need more people willing to pay up to use the AI. And then you need to make sure that Nvidia is producing the best chips and is going to capture that market share. At the moment, there's undeniably strong demand for AI. So the demand for AI is sort of actually going exponential. It's taking off. Nvidia is positioned to capture a huge part of that share. And so we think it's quite well positioned based on what we can see sort of 12 to 18 months out. If you were to pick and sort of nitpick a little bit at what's the negative in Nvidia at the moment, it's the fact that its competition's getting a bit stronger. There's a company called Broadcom, which makes very similar chips. They're called TPUs, and they make them primarily for Google. They're producing some really good chips, and they're starting to encroach on Nvidia's market share a little bit and take some of those revenues.
Looking at Salesforce then, which is this company that's making a buck out of software and also bringing more and more AI applications into the situation. And I guess, in your railway analogy, what they're trying to build trains, or they're trying to sell tickets to the trains, or they're trying to get that kind of revenue through?
Well, yeah, it actually depends on your perspective here. It could actually be that Salesforce is the horse and cart that's actually getting replaced by the train here. So, yeah, it's if you sort of look at software, what AI is going to do is it's going to make it easier, and it already is. It's making it easier and cheaper to build software. What used to take specialized engineers called software engineers, and they ability to write code and computers and basically have their own language that me and you wouldn't be able to do. We can do that now. We can type in normal English into a place, an app like Claude Code or ChatGPT's Codex, and we can ask it to create a piece of software that will do something, whether it's simple things that we're playing with. We're creating dashboards at work. We're trying to, we have a lot of information we have to process, and we're creating little software applications that actually do what we want it to do. It took you human just writing natural English language. And so in one sense, you kind of go, look, there's going to be definitely no shortage of using software products. We're going to keep using them. So Salesforce, we're going to keep using Salesforce. But other people might be able to create products which compete with Salesforce a lot cheaper and easier. And so what does that mean? Salesforce business disappears? I don't think so. I think it just means it's competition to keep its place. So at the moment, Salesforce has really large market share in this customer relationship management segment, dealing with the sales force of companies. Well, maybe companies might decide, we might try to build some of this ourselves internally. We might try to use this new AI company's come up with a cool product. We might use their product, or we might use Salesforce, but actually, we might not put the price. We might not take that 5% price increase you're trying to push through, because if you do, we might go try this. So it's an interesting dynamic. For what it's worth, we think the business isn't going to disappear anytime soon. I think we're just a little bit more concerned generally with software as do they continue these historical high growth rates? They used to grow at 15-20% of sales growth per annum. Is that now 5%? Is that 10%? And that's what we and the rest of the market are trying to figure out.
If we look at the results that they had, where you kind of had Nvidia, amazing, doesn't really get rewarded, actually drops. Salesforce, pretty good, pretty close. Actually took a dip. I think it's maybe then it climbed back a little bit. What does that tell you about what investors are seeing? Where they're at in this sort of cycle?
I mean, if you actually step back, Nvidia had fantastic results and the shares went down, and Salesforce actually had quite weak results. They sort of hit their numbers on their quarter okay, but they guided to about 1% lower revenue growth for the calendar year 26. The market expecting the shares went up. So what it tells me actually is that as the market has probably oversold software names over the last 6 weeks. I mean, most software names are down around about 30 to 40% year to date. And we're not talking about small cap software companies. We're talking about the biggest software companies in the world are down 30 or 40% when the market's flat. If you ever usually see stocks down 30 or 40, it's because the market's fallen 20 on COVID or a big sell event. I mean, seeing stocks down this much in a flat market is actually very, very unusual. And so I think the market's oversold software companies. It's probably overbought semiconductor companies, and you're just seeing a bit of a position reversal short term. I think the other thing it probably does sort of lead to is, I mean, the headlines have been so negative for software companies this entire year. It's been one thing after another. It's been Claude Code's come out and we can build our own software. Claude Cowork has come out and all of a sudden we can manage our whole desktops, and we're not going to be able to need to go in Excel spreadsheets ourselves or anymore because Claude Cowork's going to do it for us. And there's been sort of announcement after announcement of new AI company coming out with software business. I think the market's sort of going, right, this is all negative, but has the shares sold off enough now? And I think the market's finally got to the point. Let's pause. Let's have a look. What's this company worth? Salesforce is trading on around about 14 times its earnings. It used to trade on 30, 40, 50 times earnings. So its valuation's sort of over-halved. And I think the market's now going, right, we're at a point here now. I think we can start having the debate. Is this overdone?
Yeah. At the same time, I think I saw somewhere there was a point recently where Walmart was trading at sort of a double the multiple that Microsoft was trading at, which is sort of crazy. There's a tech company, it's in the toilet basically, and here's a plain old business that just helps roll stuff out the door like Briscoe's or Kmart would do here.
Part of the reason you're seeing companies like Walmart and what we sort of call consumer staples companies that provide non-discretionary services that you kind of have to buy, food and goods or healthcare, they've been trading up quite high, particularly over the last few years. They've been getting more expensive. Walmart's been executing particularly well, but over the last sort of 6 to 8 weeks, as you started seeing AI uncertainty impact software stocks selling off, investors have been sort of craving or rotating to companies where they've got more earnings certainty. So companies where you just sort of think, we kind of know what this company's going to earn next year.
They're going to pay me a dividend, maybe.
Yeah, pay you a dividend. And so you sort of attach a premium to the valuation of companies where you've got a little bit more confidence of what they're going to earn, and you've got a bit of confidence that the earnings aren't going to disappear on you in the next couple of years. And so the same reason people are selling software businesses, because they've sort of lost confidence in what they're going to earn in 5 years' time. People rotating to companies like Walmart. They're actually rotating to telcos, utility, infrastructure businesses, companies where you think AI is not really going to replace us anytime soon.
I want to come back to those two that we were talking about there, and maybe even more specifically to sort of Nvidia. These are companies that, as you say, it's got a huge future ahead of it, but a lot of that is based on not money that's coming from you or I using an application and paying Anthropic, Claude, or whatever it is to use it. It's coming from these companies, these hyperscaler companies, Meta and so on, that are putting huge bets, huge capital purchases and so on in there and saying, oh yes, we'll buy this many chips, we're going to invest this much and so on. And that's where that's coming from. So I want to try and get a bit of a sense at whether the build out is going to be sustained, because the adoption part doesn't seem to quite be turning into money at the moment.
As you say, the revenues in Nvidia are linked to continued capital expenditures from these hyperscalers, Amazon, Microsoft, Meta, and the willingness of them to continue to spend that money, and then actually the ability for them to continue to spend it via raising financing to keep spending this. And to give you some context, these companies I'd sort of use round numbers across them all, might have been spending around about $30 billion of CapEx per year a couple of years ago. We've got some of them spending $200 billion per year. So Amazon was expected to, I think it's coming into this year, was expected to spend about 130 billion, 140 billion in CapEx. It just told everyone it's going to spend 200 billion. This one company spending 200 billion on capital expenditures in a year. And so you can kind of track Nvidia's revenues. So Nvidia's expected to generate revenues of sort of about high $300 billion next year, might be 350 to 370. That number needs to be directly tied to these hyperscalers CapEx. And if you go through the hyperscale CapEx, I think they spend around about, this is taking the big five companies out there, Amazon, Meta, Google, Microsoft, and you can sort of include some unlisted ones like XAI in there. They spent about 400 billion last year in CapEx. That's expected to probably be around about 750 billion or even higher. Might even go high 700 billions in 2026. That's a massive jump. Nvidia is going to capture a big share of that. But then market's probably comfortable. They probably go, yeah, we know they're going to spend the CapEx this year, but they need to do it again. We need to keep raising that number and raising it. And these are companies that haven't really had to go into debt very much at all in the last 10 years. You're now seeing them be free cash flow negative. Meta's going to be free cash flow negative this year. Amazon's going to be free cash flow negative. Google's barely making any further, basically tipping in all of the cash flow they generate in they've got the most profitable business in the world, right? These guys generate hundreds of billions of cash flow, tipping all of that in CapEx to build data centers. A big chunk of that goes to Nvidia. And then they still don't actually have enough cash, so they're going to be raising debt. So they're tapping the debt markets now to help fuel this ride. And so, while everything's going well and people seeing AI being used more and the utilities working, I think you can get confidence that this keeps going. But what happens if you get a period where all of a sudden expectations in AI softens, then all of a sudden that's when the pressure comes on and everyone wants to see there's a return. I mean, you're going to spend $200 billion of CapEx. Investors want to see a return generated on that CapEx. And at the moment, there's pretty high uncertainty on what that return's going to be.
Yeah, right. I bet. Maybe we should talk a bit about what they're actually building so we can sort of see that. These things are doing millions and millions of processes the whole time. Is there any kind of data point that we can do trying to understand just what these things are doing and how well they're doing it?
Yeah, it's a good question. So let's break it down. What artificial intelligence is exactly that. It's providing intelligence and doing things that humans would like to do or do, but doing it faster and better than we can possibly do that. And to do that, they need to analyze information and come up with good answers and then provide it back to us. So basically a request gets put in. We type a English written language request into a large language model interface like ChatGPT or Claude. The LLM stands for large language model. So we're talking ChatGPT or Claude or Gemini. We'll take that information, it will go scan the internet, scan its database, analyze it, segregate it, maybe branch it off to its own specialized model to get the best answer, come back with the answer, look at that answer, determine if that looks right. No, I'm going to go find a bit more information, make it better, then I'm going to send it back to you. All of that takes computing power. We're using computer chips to process all that information. Now, the way large language models has sort of been designed to work is they break down complex problems into what's called tokens. And I think it's like for every one word in the English language, on average, it's something like 1.5 tokens. But then also text, images get broken down in tokens, videos get broken down in tokens. And so tokens has become, it's almost like the petrol of fuel that large language models run on. I might do a request and say, look, I've got an interview coming up with Sharesies. These are the rough questions, can you provide me answers for them? Well, that might say, yep, thank you, I'll do that, but that's going to cost you 100,000 tokens. Someone needs to pay for that, right? And so that's what these guys are building. But to run those models, they need tokens. To get tokens, they need to buy computer chips called GPUs, general processing units is what Nvidia sells, and they spit out these tokens. To run those GPUs, you need to put them attach them to power, attach them to other networking equipment, attach them to other types of computer chips. And you house all this in what's called a data center. And a lot of people like to call them intelligence factories or AI factories. They're the new factories of the world. But just to give you some context, everyone talks in gigawatts of power now when you talk about building data centers. So a 1 gigawatt data center has become kind of like the standard. I'm building a new one. It's a gigawatt data center here. That costs you about $50 billion to produce one. So, Amazon's capex of, if we're talking about 200 billion next year, that's about 4 of these 1 gigawatt data centers. Out of that $50 billion, 25 to 30 billion goes to Nvidia. So Nvidia takes the lion's share. So even though you've got to go buy this land, you set up these, these are mini football field sizes and size, build all the equipment, cooling equipment, computer racks, shells that go around it. 30 billion of it is still actually the chips. That's Nvidia. And that's the infrastructure you're putting in place to produce these tokens, to run these large language models. The LLMs are largely getting the hyperscalers such as Microsoft, Amazon, Google to build those factories for them so they can use them and sell their services to us.
This brings me to an interesting piece that I just read recently. Moody's apparently has been taking a look at this sort of stuff and saying there's a problem with the balance sheets here because some of those data centers that are being purchased or committed to, they're not going to need them for a certain period of time. And supposedly, if it's far enough in the future, you can kind of treat it as like this is an accounting thing perhaps, it's not an immediate liability, we don't need to put it on our books. And they seem to be saying there's like $600 billion worth of future liabilities that aren't even showing up on the balance sheets of some of these companies, which is equivalent to like more than they've borrowed in the last year. Is that the kind of scary talk that we should be paying attention to, or is it all just going to be fine, it'll wash out?
I probably wouldn't get too paranoid about it right now, but I think you're correct to point it out and as something to keep an eye on. So the debt levels of financing to keep funding this out is getting bigger because we started off just funding all this development out of cash flows and generators, all good, no problem. We're now getting to such size of investment that we need to start tapping into debt because you've got to remember this investment is leading what hopefully will be returns. But it doesn't. You don't monetize it straight away. At the moment, there's a huge amount of this. I estimate there's probably going to be $1 trillion spent in artificial intelligence capex in 2026. The revenues we're probably generating about AI at the moment is probably somewhere between 50 to 100 billion.
Wow.
So in 1 year, we're probably spending 10 times what the total revenues across all AI has been generated at the moment. And we're now starting to finance that with debt. So we finance that with debt of stuff we currently are not seeing the returns. And then, as you sort of point out, some of it is debt that sits straight on the balance sheet, but a lot of it is commitments for future leases to operate these data centers. So you pointed out that I think you might have said 600 billion of these off-balance sheet commitments. One company that's sort of at the forefront of sort of using its balance sheet and leveraging up to build these data centers or roll them out is Oracle. So Oracle, very, very large business, probably is going to spend 50 billion on capex this year. We'll spend up to 100 billion a year in the next few years. They already have a fair bit of debt. They've already run a sort of quite a high debt balance sheet. What they're choosing to do is not build the data center themselves. They'll get someone else to build the physical data center, the shell, get the power connected up, and they'll lease that off them. And so by leasing it off them, they'll say, look, here's a 20-year commitment that we're going to pay you an annual lease so you can set up our shell and we can go check our computer equipment and chips in it and run it. But I want you to manage the whole shell, the land, the property, getting the power in. I don't want to do any of that. You do it. But obviously, there's got a big commitment to do that. And so NVIDIA's got, I think, a loan with, I think it's with OpenAI. They're sort of trying to do 10 gigawatts worth of expansion. It's like $500 billion over maybe the next 10 years and other pieces. And so those commitments add up, massive data center leases. So I think Oracle's got about 260 odd billion worth of these commitments. They're not on the balance sheet. So you go look at the balance sheet. They won't appear on Oracle's debt level. But over the next sort of 5-10 years, as these data centers come online, they'll come onto the balance sheet at that point. That's basically saying it's really committing heavily, and Moody's aware of this, saying, look, yeah, your debt level is this today, but we kind of need to look forward a little bit here into what's going on and what your debt level may be in 1, 2, 3 years' time.
So there was a story recently as well about a little research note from an outfit called Citrini. One bit of shade thrown on the prospects of AI dislocating the amount of employment that's going to be there in the US, and suddenly people were selling off all of these companies going, oh goodness, what is going on A, with that, and B, in a market where one little note can suddenly freak everybody out.
So Curtayne is a quite a highly regarded, call it thematical type research house. So they like to think of what's going on, what might be happening in the future. But actually what they wrote in the article was things we've been talking about and thinking about sort of throughout the start of this year, right? Actually, some of the movements and share price action you saw happened well before the Curtayne article came out. And so if I explain what the paper broadly is telling us, sort of starts off by saying we spend a lot of time as investors, we kind of think about the bear case of AI, it doesn't work and all this overspend doesn't return anything. And even the base case, it sort of works okay. But until maybe this year when we saw how fast Claude Code and Claude Coworkers progressed and everyone's like, wow, AI's here now. We always sort of think it's a year or two. We haven't too much thought about the bull case where AI really is really helpful and really changes how we work to the point where it is so good that we don't need a lot of the jobs, and all the companies that are sitting there and all that with big large white collar workforces go, look, we don't need this person who's essentially just processing data because AI can do it faster than he can do it, and it can do it better, and it works 24 hours, 7 a day. So we're going to get rid of this guy that costs us $80,000 a year, and we're going to go get an AI that does this for a very small margin of the price. At the moment, we spend, I think they sort of said, round numbers, 60% of US GDP is spent on labour. And a huge portion of that's the white-collar workforce. What if AI is so good that we can replace a big portion of those jobs with AI? So if that happens, we stop spending the money to the white-collar people. We stop getting paid our salaries. I'm a white-collar worker. I stop getting paid my salary, for example. So all of a sudden, you're not paying those humans. They lose their jobs. Unemployment levels go higher, they stop getting paid. So previously you might have had a tech revolution which comes along and it impacts a very specific part. I mean, computers came along or something and it made it hard to kind of like people that did manual calculations got replaced, or you didn't need as many of them. I mean, AI might be able to replace all sorts of industries or actually have a big impact. So you can't go find another white collar job, so then you actually have to go find a blue collar job. You go be a builder. But there's already heaps of builders, so there's more. Everyone's fighting over the same job. So it sort of entertains this sort of quite doomsday type scenario where AI is actually so good it causes a big societal disruption and in the way we work. And the debate, there's been a lot of sort of follow-on since that article of people taking the other side. The debate is now firmly sitting, look, is it going to disrupt things so much that there's big sort of unemployment levels, recession that gets caused for it, we can't get these white collar people retrained to work somewhere, or will it go at a pace where we've got time for people to reskill, work with AI, come up with new companies, and all of a sudden jobs get created with new companies? And I think the answer is going to be a bit of both. And how we are viewing it is increasingly we think there is going to be some disruption to the white collar workforce.
We were talking before about scarcity and how that's the opportunity in this game in some cases.
Yeah.
Where are the bottlenecks and who are the businesses, the companies, the opportunities to invest that are potentially exposed to that?
Yeah, no, I can talk about a few. I won't give investment advice, but I'll give you a few perspectives of sort of areas where we see constraints in the AI supply chain. The sort of most talked about area has been power over the last sort of 18 months. It's been sort of the big topic of, is there enough power, and when we're going to have to fuel all these data centers, and each gigawatt they require power needs to come from somewhere. And
it's a political problem in the States, right? I mean, you've got AI companies spending the thick end of 100 million New Zealand dollars trying to get favourable legislation in states so that they can do the build out, because they know that there's this pushback coming from the locals about you sticking that great big data centre up there that's going to make my power
prices go up. And Trump's actually even just recently called the CEOs of all the largest tech firms into his office, and he's basically trying to push some of the onus on them to build their power or protect the power. And you need a huge amount of power. I think forecasts are sort of over the next number of years that AI data center power consumption will go to, I think, somewhere from a low couple percent, 2% area to 10% of US power consumption. So, and you've got to remember that power use in the US and most developed nations globally has been declining for the last 20 years. And there's the fact that, until I sort of looked into this over the last couple of years, I didn't realize, but power consumption tends to go down because things are becoming more efficient. And
deindustrialization, all the factories and stuff moving offshore.
Exactly. And so pipelines and everything was set up for what wasn't really a growing demand for power. Now all of a sudden it is growing. But when we sort of ran the numbers at Milford about 6 months ago, based on sort of reasonable estimates of where we thought our capex was going, the there's enough power on the US over the next 5 years in the grid that's expected to come on. The problem was getting that power online at the right place, the right time to get that data center in and be able to do it quickly, because it can take 5 years to get new power online, all that. There's a huge amount of regulatory compliance hurdles to get through. Over the last 4 or 5 months, our estimate of sort of where AI capex and the amount of gigawatts coming on is starting to go up higher. So you're now starting to get to that point that actually there may not be enough power generation coming on. So I think that's an area where you're going to see sort of more focus. And then, of course, chips. I haven't talked about chips, which is one of the obvious areas you talk to. Chips is a big beneficiary until the last sort of 6 months or so. As much as everyone says it's sort of demand for chips, they weren't really supply constrained. The constraint was more getting the data centers online and up to fill the chips. As in, if you got the space in the data center, you can get the chips in there. That's sort of been where it's at. Now very firmly starting to move that we can't get enough chips. There's actually quite a few data centers coming on. They're still constrained, but we're actually hitting the limits of how many chips we can produce. And there's two key areas in this. There's one that is what's called leading edge foundry. There's a business called TSMC, Taiwan Semiconductor Manufacturing Company, based out of Taiwan. It's got about a $2 trillion market cap, and it makes almost 100% of the AI chips in the world. That company is now basically sold out in what it can do for the next 2 years.
Wow.
And they're called wafers. They produce wafers, and that's what these real tiny transistors go on to produce chips. Sold out for around about 2 years. They can't produce much more. They're doing everything they can to get more online, but it takes about 3 or 4 years to build a new manufacturing facility for these chips. So they're starting to hold this supply chain back. Going with that, for every compute-powered chip, they now attach what's called a memory chip to it. Think of the RAM in your laptop, and we always get sick of slow laptops. And we're like, I need more RAM. I've got 16 gigabytes. Give me 32 gigabytes. RAM is kind of like the brains. It's what stores short-term memory. Now, this RAM, it's called DRAM in the technical part of the industry. This DRAM is now basically completely sold out for the next 2 years as well. You're getting the biggest customers in the world only getting filled for about 50% to 2/3 of their orders. Prices have gone up somewhere around about 10 times in the last 6 months alone, and it's becoming a massive constraint. All really interesting areas to look at in terms of this sort of supply chain constraint around AI build-out.
Andrew Curtayne, I feel like I've learned a lot today just listening to all of this, and I'm going to have to go away and do even more homework to try and grasp it. I just want to leave you with one question, and you can try and sum it up if you like. What's the one thing you think that retail investors most misunderstand about AI investment right now?
One thing a lot of people don't appreciate, and I wouldn't say this is just retail investors, I think this is professional investors as well, is how uncertain technology revolutions are. I think when you're sitting in it, you sort of feel like you sort of see what's going on, and it sort of feels really clear who the winners are going to be. And we look at Nvidia, we look at OpenAI, Anthropic. If you go through history, history will show it's very difficult to predict how the technology will develop over 5-10 years and who the winners will be. In most technological revolutions, companies who thought were going to be the winners at the start don't end up being the winners. And it might be a company that you never even heard of that comes out and wins. And I just apply that to AI at the moment. I mean, we have very little idea of exactly how this is going to play out in a 5-year view. We don't know who's going to monetize things well. Are the LLMs going to rule everything? Are they too competitive because there's 5 of them all competing and they don't make any money? But one thing you tend to get in technology revolutions is value accrues to the consumer. We get better technology, cheaper prices, it makes our life better. And then the investment side of thing is a bit more complex, who wins. So I think the same is going to apply here for this AI revolution.
Well, thanks for giving us a front row seat on the next sort of 6 months, 12 months and what's going on inside your head at the moment. Andrew Curtayne from Milford Asset Management, thank you very much. And you for listening, watching, thank you for your attention. Kumatu, that's the shared lunch for this week.